Hello friends, welcome to my YouTube channel Financial Markets by Sandip Agarwal. So this is video number 2 under options intermediate part 2, and in totality this is video number 10 under the total option series. So I hope you people have been liking my videos. So in case you feel that my videos are adding value to you, so please like and subscribe to my channel so that you can get notifications to any future videos which would be uploaded in future. And also, if you feel these videos are of any value, then please do share it with your friends and family so that they can also get any value additions from my videos. So let's start. So this slide I have repeated from my video number 2 under options intermediate part 2, where I have explained how the pricing of an option is derived with the help of the option grades. So like as I explained in my last video, there are 5 option grades: delta, gamma, vega, theta, and rho, which we have explained in detail in the previous video. The link of all those videos you will get in the description box of this video. So in this video and in the upcoming next 2 videos as well of this options video part 2, we will discuss in detail about this grade Vega. So this Vega is basically known in the market as IV. So IV stands for implied volatility. So this is a very detailed topic. So that's why there will be 3 videos on this single option break. If we can get hold of this concept about IV, so it will help us to understand options in a very detailed manner, and it will also help us to identify. It will basically give you an indication like in which direction market is going to move, like whether it will be bullish or it will be bearish or it will be sideways. Though it will not give you a complete surety, but it will give you a bit of idea and indication in which direction the market is going to move. So that's why we will have 3 videos on this single option Greeks, because this is one of the most important option Greeks. So Vega is also known as IV. So IV basically stands for implied volatility. The option prices and IVs, they have a direct relationship. As the IV goes up, both the call and the put option prices also goes up, and when the IV goes down, the option prices goes down, assuming that the other option Greeks, which is delta, gamma, theta, and rho, are constant. So I am talking about the change only in the IV, assuming that the other bricks are constant. In case there is a movement in the other option bricks as well, so then the option prices will change according to the change in the other option bricks as well. And IVs can be different across different option strikes and option expiries. We will discuss this point in detail in this video as well and in the upcoming 2 videos as well. So just refer to this screenshot which I have taken from one of the website named as options chart. So this I have taken only for the purpose of giving you an idea that how the IVs can be different across different strikes. So let me just zoom it. So see, I have just zoomed the IVs of the call price. So currently the market is a market that is a Nifty index is trading at around 17,300. So you can see it is highlighted in light brown color, and you can see I have taken the option prices of various strike price ranging from 16,800 to 17,600, and you can see this IV column. You can see this IV column. You can see the IV of 16,800 strike price is 26, whereas for 17,000 strike price it is 23. Similarly, for 17,300, which is ATM strike price, the IV is 21. And as we move upwards, say 17,600 strike, the IV is 90. So we will understand why these IVs are different across different strike price and why it is not the same across all the strike price in this video and the upcoming videos as well. So this is just for the purpose of showing you that how the IVs can also be different across the different strike price. This is a live market data as of 17th March 2022 end of day. I have taken it from there. You can also see that the other Greeks of the options like theta, gamma, and delta is also mentioned. And as I explained in my previous video, that the fifth option Greek, which is rho, which basically denotes the interest rate, since it doesn't have much impact on the near option expiry contract, so that's why it is not mentioned over here. But you can see the theta, gamma, and delta as well. And if you recall my last video, I have explained that the delta of call option is always positive. You can see it is denoted by positive numbers only. And I have also explained that the delta of ATM option, which is 17,300 strike in our case, is around 50.5. So you can see it is 0.5 only. And I have also explained that as we move to the out of money strike price of the call, so then the delta moves closer to zero. So you can see it is less than 0.5. So you can see the delta of 70,600 strike price, which is 300 points away from the ATM, is around 27. Whereas the delta of in the money uh, call option, uh, which is like we can take the example of 17,000 strike price, which is 300 points in the money as compared to the current future price. So you can see the delta is around 72. And similarly, the gamma is also there and theta is also there. And as I explained in my previous video, theta is always negative for both the call option and the put option, because as and when the time expires and we move closer to the expiry of the contract, then the value of the option prices also goes down, considering the time value build up in that option. Similarly, we can zoom the put options chain as well, and you can see so here also the IV is different across all the different strike price. And you will also notice a point that the IVs of the put option and the IVs of the call options are also not different. They are also a bit different. We will discuss in detail in this video and the upcoming videos about the significance of these IVs across the different strike price of the put and the call options, as well as the at the money, in the money, and out of money strike price as well. And you can also see uh, the delta of all the put options are negative. You can see the minus sign at the beginning of all the delta. And in this case also you can see 70,300, which is the ATM strike price. So for this put option strike, the delta is almost close to 0.5. And similarly, as we move in the money on the put option side, so the delta moves closer to 1. So we can see 70,600 strike price, which is 300 points away from ATM. The delta is close to minus 0.72. And similarly, as we move out of money on the put option strike price side, we can see a 17,000 strike price, which is 300 points OTM from the ATM. So the delta is close to minus 0.27. We can see that theta again, it is negative, similar to the call options as well, because the theta will always be negative, because as we move closer to the expiry of the contract and we as and when the days passes by, the option prices falls uh, in on account of the theta effect, considering that the other option Greeks are constant. And Vega is always positive for both the put and the call options, because whenever the Vega moves up, the option prices also moves up, and whenever the Vega goes down, the option prices also goes down. Just to give you a basic idea about how the option Greeks can be different across the different strike price. So this data is as on 17th of March, end of day, and this has been taken from a website named as Options Chart. So we move to the next slide. Uh, so In this slide, we will discuss about how we can calculate the IV and how to interpret it. So in a nutshell, there is no actual formula for IV, but it can be calculated in Excel with the help of the Black-Scholes model, which we have discussed in detail in the previous video. We can solve the IV through trial and error method in Excel with the help of a formula named as OLC. You will see it in the Excel itself. Whenever the IV is high, so the option price is considered to be expensive, and whenever the IV is low, the option price is considered to be cheap. So generally, there is a perception in the market that whenever the IV is high, the scenarios are ideal for the option selling because money is made more in the option selling, and whenever the IV is low, money is made more in the case of the option buying because the option prices are cheap. But this is a general perception in the market, and it differs from person to person, and the person can have a different view as well. We will discuss about this as well in detail with the help of the examples. So the option prices are generally considered as overpriced whenever the IV, which is the implied volatility, is greater than the actual volatility and vice versa. Now, we are discussing about the IV, which is implied volatility in this video. We will discuss about the actual volatility as well in the next videos with the help of the various examples. So for the time being, just keep these terms in mind. IV, which is implied volatility, and actual volatility. There will also be a term named as VRP, which is basically volatility risk premium. So implied volatility, IV, actual volatility, and VRP, which is volatility risk premium. We will discuss these three concepts as well in very detail with the help of the examples in the next two videos as well. So we come to the next thing, which is called as India VIX. So I'm sure many of you may have heard about this India VIX. So this India VIX is basically derived from a terminology called as VIX. So VIX is basically stands for volatility index. So V stands for volatility, IX stands for index. So this is an index that measures the implied volatility of S&P 500 options. So S&P 500 is an index which is basically traded in the US market. S&P stands for Standards and Poor 500. So India VIX is like a synonym for this VIX as well. And this is also an index that measures the IV, which is implied volatility of the Nifty options. So in all our videos, we have basically discussed about the Nifty index call and put options only. So this India VIX is an index that measures the IV of this index options only. So India VIX is basically calculated from the option prices as well, and it measures IV over a period of 30 days. This is basically the expectations of volatility over the next month. Like just to give you a brief idea, now say in case the IV is 30% and the current price of the Nifty is 17,300. So it means that the market is expecting Nifty to move in a range of plus minus 30% from the current 17,300 over a period of next 1 year. So 30% of 17,300 comes out to around 5,200. So market is expecting Nifty to trade in a range of 17,300 plus 5,000 plus minus 5,200 over a period of next 1 year. It can also be broken up into monthly and the weekly as well, which we will discuss in detail in the upcoming videos as well. So this is just to give you an idea what is India VIX. So just to repeat it again, in case the India VIX is 30%, so it means if the Nifty index currently is trading at 17,300, so the market is expecting Nifty index to move in a range of plus minus 30% from the current price over a period of next 1 year. So 30% of 70,300 comes to around 5,200. So the market is expecting Nifty to move in a range of 17,300 plus minus 5,200 over a period of next 1 year. India VIX in India is also known as the fear index. So it generally moves in the opposite direction to the stock market. So you will notice that whenever there is a fear and uncertainty in the market, so whenever say for the current example, whenever the risk about the Ukraine and Russia war went up in the market, the VIX started moving up and the market also started falling. So Generally, India VIX and market direction are moves in the opposite direction. Whenever the India VIX moves up, generally the market falls, and whenever the market rises, the India VIX goes down. So India VIX and the movement of the market is generally in the opposite direction. I have basically plotted the monthly line chart of the India VIX and the Nifty index. This blue line basically denotes Nifty, and this orange line basically denotes India VIX. I have not plotted the actual values of it. This chart I have just given for the purpose of explanation. So you can see, uh, if you see my cursor, so here the India VIX shot up to the highest level. It was around 80-90 levels. So it was somewhere around March 20. So you can see when the India VIX has shot up to the highest level, the market has gone down to the lowest level. By seeing this a chart of comparative chart of India VIX and Nifty, you can see whenever the market moves up, the India VIX goes down, and whenever the India VIX goes up, the market goes down. This has an inverse relations. So if somebody wants to understand in which direction the market is going to move, basically the expectancy of movement of the market in the upward direction, which is bullish, or the downward direction, or bearish, or the sideways, then if the person knows the uh, movement of the IV, the actual volatility, the volatility risk premium, and India VIX, so he will be in a better position to uh, expect the direction of the market. So let me just give you an example how we can calculate the IV with the help of the Black-Scholes models in the Excel. So if you refer to this Excel, which I have explained, like which I have given an example in the last video as well, the current price of the Nifty I have considered at 16,600. We can make it 17,300 as well. And we can make the strike price as well, 70,300, which is the current strike price. Annual interest rate, which is basically rho, I have taken 7%. Vega, which is IB, I have taken as 25%. Theta, which is basically days to expiry, I have basically taken E. And this is the delta and gamma. With the help of this option Greeks, which is delta, gamma, vega, theta, and rho, we have calculated the call price and the put option price of 17,300 strike price, which is the ATM, when the Nifty is trading at around 70,300. Now, if somebody wants to know what the IV would be in case the call price becomes 400, assuming that the other option Greeks are constant. So there is a formula in the Excel under the data option what if analysis goal seek. So we can use this formula and we can calculate manually what would be the IV or the Vega in case the option price becomes this value. So what we do, we just set this value B30. B30 is basically the call price to say 400, and we want to see what would be the IV in case the call option price moves to 400 from 532.78, assuming the other prices remain constant. So we set this value B30, which is the call option price at 400, and this value should be calculated by changing the value in the cell B5, which is the annual volatility, and we click on the OK. So you can see the Excel automatically calculates the call option price will be 400, assuming the other factors are constant, at the annual volatility level of 18%. So if you have the delta, gamma, rho, and theta with you, so annual volatility of Vega or IV you can calculate with the help of this Excel. In case you have the Black-Scholes model plotted in the Excel, so with the help of the Cold-Seek formula, you can back calculate the annual volatility. That's it from my side. I hope you people have liked my video. In case you have liked, please do like and subscribe. And in case you have any comments, please feel free to give your comments and feedback in the comment section. and I will try to address all those comments in the